you cover your thoughts on when it's a good idea to take some or all profit on a stock? Okay, let me ask you a couple of questions here. First of all, right? What's the maximum downside on any one stock? I haven't frozen there. It's 100%. Or if you insert a stop loss, it's less. So for me, it's 20% pretty much. As long as it goes up there, as long as it doesn't gap down. It's very rare it gaps down 20% below the thing. What's the maximum upside on any stock? Maximum upside. Anyone? That's on Ferris Bueller's Day Off. Anyone? No idea. No idea. You have no idea at all. Okay? If you pick the right stock, it can be multiples of your initial investment. And over time, it can do that. And I don't want in a day or 2 days or a month. If a good company, that's fundamentally growing, it's good value, and it keeps getting, the value is keep being compelling, it can keep going up. In fact, companies even overvalue keep going up. So value is a very arbitrary thing. We do put these models based on peers and all that and say, but sometimes stocks can rally way beyond what's reasonable value. So sometimes you're taking a profit because the stock has risen. You shouldn't really do that because it can rally beyond where you think it would rally. So it makes sense to limit your downside. It means stop the loss getting bigger, but not limit your upside. Okay? You will invest in companies that can be surprise losers. And sometimes, if you literally, go with your gut, sometimes you think, oh, this is going to be a massive winner. And this is the problem. You can go too big on a stock you believe is going to be a winner before it wins. And it starts losing. And then you're really in trouble because you've got a big hold in the company, it starts losing. What do you do then? But also you can get some surprise winners. That's why, the strategy I use is pretty much, roundabout equally weighting any initial investment similarly, because one may take off that you didn't think it would take off, and one may drop that you didn't think would drop, So you start off and then you can average up the winner. Wait till the winner starts winning before you start averaging up. If the loser starts losing, as long as you've gone small, doesn't matter. Maybe even more put a stop loss in, cut 20%. If you've gone really small, doesn't matter too much anyway. But there's only one thing worse than deciding to hold on to a loser that becomes a bigger loser. Do you know what that is? Selling a winner for a small profit and see it go into multi-bag. That is gutting. Absolutely. Like I said, as far as two emotions are concerned in the market, and actually having a loser to get it bigger is horrible because you thought it was going to be a winner and you've gone too big on it. That's nasty. But when you see a company, we'll take a nice little bit of profit on that. Yeah, 20, 30%. And it goes on to 300%. Oh my God. That is not a good sign. So how do you avoid that? Let's give an example of a winner, of a winning stock. Let's say you invested in New Group in October 2022 after it broke the 200-day moving average and made a new high at 240. So this is the chart, okay? So down here, it broke that. It spiked up to, say, 238 there. It's still above. It came back a little bit, and then it made a new high. That's a good sign after 200-day. So you bought at 240, say, okay? By November, it was 294, which is a 23% profit. You could take a little bit of profit there, thinking, oh, wow. Because you don't know where it's going. You think, oh, I'll take a bit of profit there, okay? So 23% there, entry here. Could have done that, okay? Let's come back. Oh, I did the right thing. Let's come back up again. Oh, let's come back down. Oh, I think I did the right thing there. 23% profit. Excellent. But this is limiting your upside, as you don't know where the share price will rise to. I don't know why I put two O's in there. So, rather than limiting your upside, limit your downside, i.e. put a stop loss at your buy price. Therefore, creating a risk-free investment. There's nothing better than that, okay? Aim for that initially. That's what you need to aim for initially. So, stop loss is now 240. Okay, that's where you bought at. You can't lose there. And it's gone up. You don't know where it's going to go, okay? The idea is to avoid losing money. That's the main thing. Think of that. The idea is to avoid losing money. Think risk, not reward at the start. When you risk your capital at the start, there's no reward. There's just risk. So think about risk. When you think about reward, you go too big. And if it goes wrong, oh, you can't dig yourself out of that hole. So once you have a risk-free investment, you can't lose. The only other two options are break even or make a profit. If you remove the list, there's only three things can happen, isn't there, in investment? Make a loss, make a break even, or make a profit. Once you remove that loss side, it's literally you can relax. With your group, look what happened next. It did 230%. Okay, to March 2023. If we put a stop loss at 240, say. So what happens here? So when you take a profit, that's the thing. Every time the share price rises by 20%, you can increase your stop loss. Not all time. I'll show you now. So stop loss has risen by 20%. You can see here. Okay, so you're now 288 a share. The share price has gone up to 336. So first of all, that's gone up by 40%. So if you're looking at your portfolio, you're 40% up. All right. Raise your stop loss from 240, your buy price, to 288. Okay, so if it comes down, you've still made 20% anyway. All right. Then every time it goes up to 20%, do it again. Now, I recommend you doing this for 3 times maximum. That's all. So look at this. It's gone up again. You're now at 60%. That's 384 a share. Okay. You put your stop loss at 336. So now you're 40%. That's it's in the bag. Even though your portfolio is showing 60% up, if it goes wrong, you're still going to make 40%. One more time. If it goes up by 20% again, move it up. So you're now at 60% your stop loss. That is showing at 433 a share, 80% up in your portfolio showing. But if it goes wrong, you're still 60% up. You've still made 60%. Okay. At this point, I would stop moving the stop loss at 20% increments when the share price rises by 20% for 2 reasons. First of all, 60% is a great return. I'll explain why. If you earn 60% of 10 investments and started with £1,000, you'd have £109,000. 60% is phenomenal returns, okay? So if you get a level and your luck's in, just leave it there, 6%. Second, a bigger pullback than 20% is likely if it hasn't happened already. So you've got to be a bit careful with the stop losses. Sometimes, if you're on risk for investment, you can be more, don't have to raise it by 20% all the time. You're better to be a little bit slower on these stop losses than keen. If you're overly keen, you get tripped out. And I've had that many times. You can get tripped out with a little pullback, all right? So, but do not limit your upside. That's the thing. Don't just take a profit because you never know where it could go. You know, it could be a stand-up point. Something can happen to the business. It could land a massive contract. You don't know, a hookup with somebody else. You don't know what can happen. You know, the market sort of sector could change, dynamics to positively reflect in this company. Anything can happen that's positive you don't know about. Let's have a look at what happened to you group. Okay, so it went up by 620% from that 240 level. And your stop loss is at 386. Okay, and the last stop loss you put in. Now I would start moving up, of course, once it starts getting up here and stuff. I would start moving up, but I wouldn't be as keen to move it up. If it jumped up like I was 100% up, and maybe put it sort of, 120% up, maybe put it to sort of 80%. Let's have a look back at the pullbacks because this is what I'm saying. I did several charts of this, big winners. And you tend to find do have pullbacks greater than 20% after a while, after a good few rises, they do have pullbacks. So the first one had a pullback at what was it, £8. Came back down to just over £4. It pulled back by 43%. But your stop loss was still here, so it avoided it. So and you were missed out on this. Next few pullbacks it's had has been 20%, 21%. So expect when you've had a big rise like this, almost straight up from like 240 to £8, you can expect a big pullback. But if you want to actually capture that multi-year, multi-bagger, then you've got to be a bit more relaxed with stop losses. It's easier said than done, but I wouldn't keep moving up every 20%. So I think 3 times when with the stock price up by 80%, you're up by 60%. I'd leave it for a while and see where it goes because that's still a good return anyway. But if you want to capture that, several 100%. I bought next in 1991 at 20p and sold at 21p. That was the start of my share buying and selling. I know. Well, that's the thing. You see, yeah. You pick the right. That is exactly the conundrum, Rob. You can pick the right stock, okay, and that's the what to buy and the when to buy. pretty much. But it's the how, that's the management of it, is really key as well, by really locking in that profit. So initially, I said focus on the risk a little bit. As long as you can't lose too much, and then you can lock off that risk-free investment. So you get 20, 30%, maybe even a bit more than 20%, because otherwise it'll come back down. But if you get to 30%, you should never lose on a stock. Once you're up 30% up, you should always put a stop loss in your buy price. 20, 30%, always. Once you can't lose any money on that. So that's what you need to aim for, first of all, what happens if you stop loss on and there's a bad RNS and it was below your stop loss? Yeah, that can happen. But hopefully, if you've done the what part and you've researched it, and these companies are, like I said, they're growing, they're good value, they're decent companies. We're not talking about oil and gas stuff like this, but if it comes down to that, then it'll happen. And also, it could be just started off small anyway, then it won't harm you too much. So if you're talking about sort of less than 3% of your total portfolio value, and it drops down by 50%, So for example, I do 1 to 2% at the moment, and so even if it did gap down, it wouldn't hurt me too much. But as long as you start small, don't believe you've got to win you're on your hands until it starts winning, because there are many other things going on in the market, the supply and the demand of the share than you think. So you start small, put a stop loss in. On the very rare occasion that happens, doesn't matter if it does happen, because of say you started small anyway.